Breaking. China's state-owned banks can't hold up. Depositors panic as funds flood out of the system. Recently, China's financial sector has faced major turbulence, and things aren't looking good. The banking system, once thought to be stable, is now teetering on the edge of a collapse. And this time, it's not just the small and medium-sized banks that are struggling, it's the big state-owned ones too. A looming liquidity crisis is rapidly approaching, and experts say that the situation could get worse before it gets better. In June 2025, a staggering 4.2 trillion yuan in negotiable certificates of deposit, NCDs, is set to mature, setting a new record for the amount due to be repaid in 1 month. NCDs are essential to a bank's liquidity. They're a tool that banks use to raise cash. However, this vital part of China's banking system is now facing significant risk, and many analysts are worried about what will happen when those 4.2 trillion yuan need to be repaid. Meanwhile, deposit interest rates are falling even further, which could cause another wave of capital to flow out of the banks. The situation is growing worse by the day. On one hand, there is an enormous debt repayment burden. On the other, depositors are likely to pull their money out of the banks, which could lead to a financial collapse. This combination of factors means that China's banking system is facing its biggest test yet. To make matters worse, interest rates on deposits have been slashed. Demand deposit rates are now as low as 0.2%, and time deposit rates have fallen to around 1%. This makes it harder than ever for banks to attract new deposits. The 6 major state-owned banks in China made a big announcement on May 20th, 2025. They revealed that they would be cutting deposit rates even further. For the first time, the 1-year deposit rate dropped below 1%. This move was a response to the central bank's policy to reduce interest rates. The changes have had a severe impact. For example, in April 2024 alone, 3.9 trillion yuan in deposits vanished from the banking system, flowing into the bond market and other non-bank financial systems. This was a historic amount, and it set a record for the largest outflow of funds in a single month. With a sudden outflow of billions of yuan, analysts predict that by June 2025, deposit outflows could once again exceed 4 trillion yuan. At the same time, the banks need to repay 4.2 trillion yuan in NCDs. So while the banks are trying to manage their debt, they are also losing deposits at a rapid rate. The situation is becoming unsustainable, and the pressure is building on the financial system. In response to the worsening situation, China's central bank stepped in to try and stabilize things. In May 2025, they reduced the reserve requirement ratio by 0.25 percentage points, releasing more than 1.2 trillion yuan into the banking system. They also injected liquidity through the Medium-Term Lending Facility, MLF, putting 1 trillion yuan in medium-term liquidity and around 600 billion yuan in short-term liquidity into the market. But despite these efforts, panic in the market has not been eased. In late May, the 6 major state-owned banks, including ICBC, CCB, and ABC, saw their 1-year NCD rates rise, which suggests that the market is losing confidence in the central bank's ability to stabilize the situation. This rise in NCD rates is a major warning sign. NCD rates serve as a signal of a bank's creditworthiness. When these rates rise sharply, it indicates that insiders are concerned about the bank's ability to repay its debts. Between May 16th and May 28th, the rates for some of China's largest banks rose by more than 5 basis points, a rapid increase that suggests something is very wrong behind the scenes. This rise in rates means that banks are paying more to borrow money, while their ability to earn a profit is shrinking. It's a sign that the banks are heading into a liquidity crisis. In 2024, China's GDP grew by just 4.5%, which was far below expectations. Meanwhile, the M2 money supply grew by 8.3%, indicating that more money was being printed. But this extra cash isn't making its way into the real economy. Instead, it is stuck in the interbank lending system, contributing to the financial crisis. On one side, the banks have an abundance of money, but on the other side, they are facing a massive wave of bankruptcies, bad debts, and the threat of bank runs. The financial system is on the verge of a collapse. One of the key issues in China's banking sector is the sheer volume of bad loans. According to data from the central bank, the bad loans in China's banking system reach 3.3 trillion yuan by the end of 2024. However, this number doesn't include all of the bad debt. For example, bad loans related to local government bonds and personal loans are not included in the 3.3 trillion yuan figure. Industry insiders estimate that the total amount of bad debt in China's banking system could be as high as 50 trillion yuan. With China's M2 money supply at 326 trillion yuan, this represents a terrifyingly large portion of the country's economy. Many major banks in China are now quietly halting their high-interest, high-return car loan installment businesses, which had been a significant source of revenue. Sources say that any commission above 3% is now considered high and is being stopped. This shift reveals that banks are running out of money and can no longer afford to sustain their loss-making businesses. The collapse of the car loan market is just one example of how the banking system is failing to keep up with its obligations. The problems in the banking sector are not just about numbers. They are having a real impact on people's lives. In many cities, people are having trouble withdrawing money from their bank accounts. Some customers have reported bizarre situations, such as being told they can't withdraw money unless they wait in person at the bank. And in some tragic cases, people have even died while waiting to access their funds. This has sparked outrage online, with many questioning the integrity of the banks. As the financial crisis deepens, it's clear that China's banking system is in serious trouble. Many senior banking officials have resigned or been investigated for corruption. The government's anti-corruption efforts have intensified, with dozens of banking officials being investigated for alleged violations of the law. This crackdown is seen as a necessary step to address the deep-rooted problems within the banking sector, but it also highlights the magnitude of the crisis. In addition to the issues with the banks, the broader economy is also struggling. Local government finances are stretched thin, and many government employees, including healthcare workers and civil servants, are facing unpaid wages or salary cuts. This is making it even harder for people to spend money and participate in the economy. As the government cuts back on social welfare and other programs, consumer demand continues to fall, and businesses are struggling to stay afloat. The situation is becoming more dire by the day. Many people are looking for answers, but the reality is that no one really knows how long China's banks can survive. The government is doing what it can, but with the country's debt levels rising and bad loans piling up, the future looks uncertain. What is clear is that the Chinese banking system is in crisis, and unless significant reforms are made, the financial collapse could be inevitable. China's local finances collapse, trade-in subsidies cut, civil servant salary cuts widespread. The old for new policy was supposed to be a way to help people upgrade their old appliances by trading them in for newer, more energy-efficient models. But things aren't going as smoothly as expected. This program, launched by the Chinese government in March 2024, aimed to boost consumer spending, help reduce energy usage, and clear out excess stock from businesses. However, instead of being a helpful hand for consumers, the program has turned into a bit of a mess, causing confusion and frustration among those it was supposed to help. The government's plan was ambitious, offering subsidies for home appliances, cars, and even digital products like smartphones and laptops. The government set aside a lot of money for these subsidies, up to 20,000 yuan for electric vehicles and a 15% discount on digital products. This money was meant to encourage people to replace their old items with more energy-efficient options, helping both consumers and businesses in the process. However, the reality of the program hasn't been as positive as expected. Recently, big news hit. The subsidies in places like Jiangsu and Henan were coming to an end. The Yunshan Fu coupon channel in Luoyang, Henan, shut down at 9 p.m. on June 9th, while the subsidies in Xinjiang, Henan, and Jiangsu province ended earlier in the week. As the deadline loomed, people who needed home appliances were urged to act fast, but many didn't know that the system was already falling apart. The government's own notice revealed that only 300 million yuan remained for the entire province of Jiangsu, which was being used up quickly. It wasn't just Jiangsu. The problems were spreading. In Chongqing, the subsidies ran out on June 4th, making it the first area to exhaust its funds. By June 6th, the Chongqing Commerce Commission made the official announcement the old for new subsidy was no more. The city's consumers, who had been counting on these discounts to get new appliances, were left without any support. Other provinces like Guangdong, Gansu, and Liaoning followed suit, suspending the program in many areas, unable to provide the promised help. This quick collapse of the program, right before the June 18th shopping festival, caused a lot of panic. Consumers were left confused and frustrated, with many feeling that they had been misled. What was supposed to be a great opportunity to help people upgrade their home appliances and digital products now seemed like a scam. The initial excitement turned into disappointment, and many began to voice their concerns online. Some people started sharing their experiences on social media, complaining that after the announcement of the subsidies, the prices of products had gone up. Appliances that were supposed to be discounted were suddenly more expensive, or the products people wanted weren't available at all. For example, one person in Beijing wanted to replace her old laptop using the subsidy program. She had found a laptop that normally cost over 9,000 yuan, which would only cost about 7,000 yuan after the subsidy. But after just a few days, the price increased by 200 to 400 yuan, and the model she wanted was out of stock. The subsidy had almost no effect on the final price, which was frustrating for those who had hoped to take advantage of the program. A similar situation happened with a student from Beijing University who wanted to buy a Lenovo laptop. Before the subsidy, the laptop was priced at 5,499 yuan. After the subsidy, it dropped to 4,399 yuan. But just days later, the price went back up to 4,559 yuan, higher than the original price before the subsidy. The prices didn't drop significantly, and in some cases, they even went up, leaving consumers feeling cheated. The subsidy situation has revealed something even more concerning. Many consumers have noticed that merchants were taking advantage of the system. Instead of offering real discounts, some merchants raised prices before the subsidies and then used the government money to cover a small portion of the cost, leaving consumers to pay almost the same amount as they would have without the subsidy. Some stores even required people to buy expensive accessories in order to use the subsidy. If you wanted a phone or appliance at a discounted price, you had to buy a bundle of accessories, whether you needed them or not. This tactic was not only frustrating for consumers, but it also raised questions about how the subsidy was being used. The government had created this program to encourage people to spend money, help the economy, and make their lives a little easier by upgrading their old appliances. However, it's clear that the system didn't work as expected. The program was supposed to boost consumption, reduce energy usage, and ease the inventory pressures on businesses. But many of the businesses took advantage of it, and in the end, the consumers didn't benefit as much as they were supposed to. What's worse is that the entire program was underfunded. Local governments, especially in the central and western regions of China, were unable or unwilling to provide the necessary funds for the subsidies. While the eastern regions were able to give out subsidies, the central and western regions ended up paying more than they should have, which just added to the frustration. Manufacturers also raised their prices in anticipation of the subsidy money, making it hard for consumers to actually get a good deal. The government was trying to help, but they created a system that had too many holes. The subsidies were supposed to go directly to consumers to make products more affordable, but instead, the money mostly went to manufacturers and retailers, with little benefit for the people who needed it most. The situation is becoming a bigger issue, especially with the ongoing economic problems in China. The government's debt has reached an alarming level, and local governments are struggling to pay their employees, including healthcare workers, who are facing severe salary cuts. In fact, many civil servants and workers in public institutions have been complaining about not getting paid on time, and some even had to take out loans just to cover their expenses. Hospitals are borrowing money to pay their staff, and other government workers are facing the same problem. The government's financial issues are directly affecting the economy, and consumers are feeling the impact of that. In conclusion, the old for new subsidy program was intended to help boost the economy, but it quickly became a mess. From the price hikes to the retailers taking advantage of the subsidies, it's clear that the program wasn't as effective as it was meant to be. The money was supposed to help consumers, but instead it mostly ended up in the hands of businesses. With the government facing a financial crisis, it's unclear if similar programs will continue and whether or not they will actually benefit the people they are supposed to help. As the country deals with its economic challenges, It's clear that consumers need to be more cautious and aware of how subsidies and government policies can be misused.